Imagine waking up one morning and realizing that you have been so focused on paying bills, raising kids, building a career, that you forgot to build a future. No retirement savings. No investment portfolio. Maybe a 401k that barely has enough to cover 2 years of expenses. You are 42 years old. Or 47. Or 51. And the question that keeps you up at night is this: is it too late? If you have ever asked yourself that question, this video is for you. Because the answer is no. It is not too late. But I want to be honest with you from the very beginning, the rules are different when you start investing after 40. The mistakes are more costly. The timeline is shorter. And the stakes, given the current state of the American economy, have never been higher. Today, we are going to walk through everything you need to know about building real wealth starting in your 40s or 50s. In plain English. With real numbers. And real strategies that work in today's economic environment. Welcome to Fortune Files. Let's get to work. Before we talk about solutions, let's understand the scale of the problem, because it is much larger than most people realize. According to a 2023 survey by the Federal Reserve, approximately 37% of non-retired American adults say they feel their retirement savings are not on track. That is more than 1 in 3 working Americans who look at their financial situation and feel a quiet panic. And here is the part that is rarely said out loud on financial television. The median retirement savings for Americans between the ages of 55 and 64, the people who are closest to retirement, is just $134,000. If you retire at 65 and live to 85, which is close to the average life expectancy in the United States, that money lasts about 6 years. Then it is gone. Meanwhile, the Social Security Administration projects that by 2033, the trust fund reserves may be depleted to the point where benefits could be reduced by roughly 23%. We are talking about a generation of Americans, your generation, who did everything they were supposed to do. They worked hard. They paid their taxes. They raised their families. And now they are looking at a financial system that was never fully designed to support them. But here is the critical point: none of that history changes what you can do right now. And right now, despite all of those headwinds, the opportunities available to a 40-something American investor are genuinely remarkable, if you know how to use them. So how did we get here? The story of why so many Americans are unprepared for retirement is not about laziness or irresponsibility. It is about a series of economic shocks that hit middle-class Americans harder than any other group. If you are in your 40s today, you were in your 20s during the dot-com crash of 2000 and 2001. You were starting your career during one of the worst job markets in a generation. Then, just as things started to stabilize, came 2008. The Great Financial Crisis. The stock market lost nearly 57% of its value between 2007 and 2009. Housing prices collapsed. Millions of Americans lost their jobs, their savings, and their homes. And just when a whole generation began to rebuild again, a global pandemic in 2020 triggered the fastest market crash in history, followed by the worst inflation the United States had seen since 1981. By 2022, the S&P 500 was down more than 19% for the year. The bond market had its worst year in over 150 years. Inflation peaked above 9%. And the Federal Reserve raised interest rates 11 times in less than 18 months. If you feel like the economic system has been working against you, there is data to back that up. But none of that changes what is possible starting today. When people say it is too late to start investing after 40, they are usually thinking about compound interest. The idea that money needs decades to grow. And they are right, to a point. If you are 25 years old and invest $500 per month with a 7% average annual return, by the time you are 65, you will have approximately $1.3 million. If you start at 40 doing the exact same thing, $500 per month, 7% return, you will have approximately $510,000 by age 65. That gap is real. It is painful. And it is exactly why we need to have an honest conversation about what it takes to close it. The answer is not magic. The answer is a combination of 4 things: higher contributions, smarter tax strategy, specific investment vehicles designed for catch-up, and an understanding of how to make risk work for you, not against you. Here is something that most people over 40 do not fully understand, and it could be worth tens of thousands of dollars to you. The IRS allows Americans who are 50 years of age or older to make what are called catch-up contributions to their retirement accounts. For a 401k in 2024, the standard contribution limit is $23,000 per year. But if you are 50 or older, you can contribute an additional $7,500, bringing your total to $30,500 per year. For an IRA, the standard limit is $7,000. With the catch-up provision, you can contribute $8,000. If you are 50 years old and you max out your 401k contributions at $30,500 per year for 15 years, with a 7% annual return, you would accumulate approximately $760,000 by age 65. That is not a small number. That is a real, livable retirement fund. The system was actually designed to give late starters a fighting chance. Most people just do not know it exists. Before you invest a single dollar, you need a complete and honest picture of where you stand. This means sitting down, today, not next week, not after the holidays, and answering 5 questions with total clarity. Number 1, how much debt do I carry, and at what interest rates? Number 2, what does my monthly cash flow actually look like, income minus expenses? Number 3, do I have an emergency fund covering 3 to 6 months of living expenses? Number 4, what retirement accounts do I currently have, and what is in them? Number 5, what is my net worth, total assets minus total liabilities? These are not comfortable questions. But they are necessary ones. You cannot build a map to a destination you have never clearly defined. Now let's talk about debt. There is a debate in the personal finance world about whether you should invest while paying off debt. For most Americans today, here is the simple version. Any debt with an interest rate above 7% should be your priority before you invest aggressively. Why 7%? Because that is approximately the long-term average annual return of the S&P 500. If you are paying 24% interest on credit card debt and simultaneously investing money into a portfolio that returns 7%, you are losing 17% every year. That is the math. It is not flexible. However, and this is important, you should still contribute enough to your 401k to capture any employer match. An employer match is an immediate 50 to 100% return on your contribution. No investment in the world offers that. So the order of operations looks like this. First, contribute enough to your 401k to get the full employer match. Second, build a small emergency fund of $1,000 to $2,000. Third, aggressively pay off high-interest debt. Fourth, build your full emergency fund of 3 to 6 months. Fifth, maximize your retirement contributions. Sixth, invest in taxable brokerage accounts for additional growth. Now let's talk about the accounts that will change your life. The accounts you choose to invest in matter, perhaps more than any other single decision you will make. The traditional 401k. Contributions are made pre-tax, which means you reduce your taxable income today. The money grows tax-deferred, and you pay taxes when you withdraw in retirement. This is especially powerful if you are currently in a high tax bracket and expect to be in a lower one in retirement. The Roth 401k. Contributions are made after tax, but the money grows tax-free and withdrawals in retirement are also tax-free. This is a powerful tool for investors who believe tax rates will rise in the future, which, given current federal debt levels, is a very reasonable assumption. The Roth IRA. One of the most powerful retirement vehicles available to American investors. Tax-free growth. Tax-free withdrawals. No required minimum distributions during your lifetime. And you can withdraw your original contributions at any time without penalty. As of 2024, the income limit for full Roth IRA contributions is $146,000 for single filers and $230,000 for married filing jointly. And then there is the Health Savings Account, the HSA. This is the most underused triple tax-advantaged account in America. If you have a high-deductible health plan, you can contribute up to $4,150 as an individual or $8,300 as a family in 2024. Contributions are tax-deductible. Growth is tax-free. And withdrawals for qualified medical expenses are also tax-free. After age 65, you can withdraw for any reason and simply pay regular income tax, making it function like a traditional IRA. Now let's build your portfolio. Here is where many investors over 40 make a critical mistake. Fearful of running out of time, they become overly conservative, piling everything into bonds and cash. The result is a portfolio that barely outpaces inflation, if it does at all. The other extreme, investing heavily in speculative assets trying to make up for lost time, is equally dangerous. If you are 42 years old and plan to retire at 67, you have a 25-year investment horizon. That is not a short timeline. Over any 20-year period in modern stock market history, the S&P 500 has never produced a negative return. A reasonable starting framework for a 42-year-old might look something like this. 60 to 70% in broad-based stock index funds. 20 to 30% in bond index funds. And 5 to 10% in international stock funds. As you approach 55 and then 60, you gradually shift more toward bonds and stable assets. Your portfolio does not need to be aggressive enough to make you rich overnight. It needs to be balanced enough to grow consistently for 2 more decades. And now I want to tell you something that the financial media rarely emphasizes, because it does not make for exciting television. The simplest investment strategy is almost always the best one for long-term investors. In 2007, Warren Buffett made a public bet of $1 million. He wagered that a simple S&P 500 index fund would outperform a basket of actively managed hedge funds over 10 years. He won. The index fund delivered a cumulative return of 125.8%. The hedge funds, run by some of the most sophisticated investors in the world, averaged just 36.3%. This is not an anomaly. Study after study has shown that over long periods, low-cost index funds outperform the vast majority of actively managed funds. For a late-stage investor trying to maximize growth while minimizing unnecessary risk, a portfolio built primarily on low-cost index funds from providers like Vanguard, Fidelity, or Schwab, with expense ratios below 0.1%, is a proven, defensible, and historically effective strategy. We have been through a jarring inflation cycle. By June 2022, the Consumer Price Index had risen 9.1% year-over-year. The highest reading in 40 years. For Americans in their 40s and 50s, inflation is not just an economic metric. It is the difference between your retirement savings being enough, and running out of money before you run out of life. Consider this: if inflation averages 3% per year, a dollar today will only have the purchasing power of about 55 cents in 20 years. That means if you retire with $500,000 and need $50,000 per year to live on in today's dollars, you will actually need closer to $90,000 per year by the time you are 20 years into retirement. This is why keeping too much money in cash or low-yield savings accounts is its own form of financial risk. The purchasing power of that money erodes quietly, year after year. Assets that have historically provided protection against inflation include broadly diversified stock index funds, real estate investment trusts, also known as REITs, Treasury inflation-protected securities, or TIPS, and I-bonds issued by the U.S. Treasury. Now let's talk about interest rates, because this is the most powerful force in all of modern finance. Between March 2022 and July 2023, the Federal Reserve raised the federal funds rate from near 0 to 5.25 to 5.5%, the highest level in 22 years. Mortgage rates rose above 7% for the first time since 2000. Monthly payments on a $400,000 home more than doubled compared to the pandemic-era lows. Bond prices fell sharply. Growth stocks were hit hard. But there was an upside for savers. For the first time in more than a decade, high-yield savings accounts, money market funds, and short-term treasury bonds began offering meaningful returns, sometimes above 5%. The lesson for every investor: interest rate environments change. And the investors who understand what those changes mean for different asset classes are the ones who can position themselves to benefit rather than simply react. For most American families in their 40s and 50s, their home is their single largest asset. Between 2020 and 2022, U.S. home prices rose by an extraordinary 40% in many markets. Homeowners who had been paying mortgages for 10 to 15 years suddenly found themselves sitting on significant home equity. That equity is part of your net worth. But it is not liquid, and it should not be confused with retirement savings. If you are counting on your home as your primary retirement asset, you are taking a concentrated risk. Real estate markets are regional. They are cyclical. And they are not always liquid when you need them to be. A diversified financial portfolio, stocks, bonds, tax-advantaged accounts, is more flexible, more liquid, and more reliable as a retirement foundation. Now let's talk about the mistakes. Because avoiding the wrong moves is just as important as making the right ones. The first mistake, and perhaps the most damaging, is trying to make up for lost time with speculation. The psychology is understandable. You feel behind. You see stories of people who made fortunes on cryptocurrency, meme stocks, or options trading. You think, if I could just hit one big trade, I could catch up. But speculative investing is not a retirement strategy. It is a lottery ticket. The data is unambiguous. The vast majority of individual traders underperform a simple buy-and-hold index fund strategy across every asset class and every time period studied. And unlike a 25-year-old who can lose half their speculative portfolio and recover over decades, a 47-year-old who loses $80,000 trying to trade crypto does not have the same runway. The math simply does not work. Take measured risks with a small portion of your portfolio, 5% or less, if you feel the need to explore individual stocks or alternative assets. But never mistake speculative activity for investing. The second mistake, ignoring fees. A fund with a 1% annual expense ratio may not sound like much compared to a fund with a 0.05% expense ratio. But over 25 years, that difference in fees on a $300,000 portfolio can cost you more than $200,000 in lost returns. Always check the expense ratio of every fund you invest in. For index funds, there is almost never a reason to pay above 0.2%. The third mistake, neglecting tax efficiency. Asset location, the question of which accounts hold which types of investments, can add significant value to your portfolio with zero additional risk. The general principle, hold tax-inefficient assets, such as bond funds, inside tax-advantaged accounts like your 401k or IRA. Hold tax-efficient assets, such as broad stock index funds, in taxable brokerage accounts where you can benefit from long-term capital gains rates. The fourth mistake, and one of the most consequential, is underestimating healthcare costs. According to a widely cited estimate from Fidelity, the average American couple retiring at 65 in 2023 will need approximately $315,000 in savings just to cover healthcare expenses throughout retirement, and that figure does not include long-term care. If you retire at 62, you will need to fund your own health insurance for 3 years before Medicare eligibility. Marketplace premiums for a 62-year-old can exceed $1,000 per month per person. Failing to account for healthcare costs is one of the most common and most consequential planning errors made by Americans in their 40s and 50s. Strategies to mitigate this risk include maximizing HSA contributions, considering supplemental insurance, and potentially choosing to work part-time in early retirement to maintain employer-sponsored health coverage. For the average American, Social Security will provide somewhere between 30 and 50% of their retirement income. It is not enough to retire on a loan, but it is a guaranteed, inflation-adjusted income stream that no portfolio can fully replicate. The single most powerful decision most Americans can make regarding Social Security is also the most commonly misunderstood: when to claim. You can begin claiming Social Security as early as age 62. But your benefit will be permanently reduced, by as much as 30% compared to what you would receive at your full retirement age, which is 67 for people born after 1960. If you delay claiming beyond your full retirement age, your benefit grows by 8% per year until age 70. That is a guaranteed 8% return. No investment in today's market can promise that. For a married couple where one partner has significantly higher earnings, a common strategy is to have the higher earner delay as long as possible, while the lower earner claims earlier to provide income during the transition. The math is complex and highly personal. But the central message is simple: do not claim Social Security automatically at 62 just because you can. Understand the lifetime implications first. On the topic of real estate, it remains one of the most effective wealth-building tools available to middle-class Americans. Not necessarily because of market appreciation, but because of leverage and cash flow. A rental property purchased at 40 can be fully paid off by retirement at 65, providing a stream of passive income that supplements Social Security and portfolio withdrawals. Real estate investment trusts, or REITs, offer a more accessible alternative for investors who do not want the responsibilities of property ownership. REITs are required by law to distribute at least 90% of their taxable income as dividends, making them an attractive income-generating asset class. However, real estate should be viewed as a component of a diversified strategy, not a standalone solution. One of the most powerful shifts a late-starting investor can make is to challenge the conventional definition of retirement. The traditional model, work until 65, stop working entirely, live off savings, is increasingly out of step with both economic reality and human psychology. Research consistently shows that people who maintain some form of purposeful activity in retirement report higher levels of health, happiness, and longevity. And financially, even modest part-time income dramatically reduces the pressure on your portfolio. If you earn $20,000 per year in part-time work during your early retirement years, that is $20,000 you are not drawing from your portfolio. Compound that effect over 5 years and the impact on your long-term financial security is significant. This is not an argument against full retirement. It is an argument for designing a retirement that is both financially sustainable and personally fulfilling. There is one behavioral trait that separates investors who build wealth from those who do not, and it has almost nothing to do with picking the right stocks. It is consistency. The investors who build real wealth over time are almost never the ones who made spectacular individual trades. They are the people who contributed to their 401k every single paycheck, without exception, for 20 years. The people who did not panic and sell during 2008 or 2020. The people who set up automatic contributions and then mostly left their portfolios alone. This is called dollar-cost averaging. By investing a fixed amount on a regular schedule, regardless of what the market is doing, you automatically buy more shares when prices are low and fewer when prices are high. Over time, this reduces your average cost per share and smooths out the volatility that derails so many investors. The market will have another correction. There will be another crisis. There will be another moment when every headline is screaming that the economy is collapsing and you should sell everything. The investors who will be financially secure at 70 are the ones who do not react to those moments. They are the ones who have a plan, trust the plan, and keep contributing regardless. Let us come back to where we started. You are in your 40s or 50s. Maybe you feel behind. Maybe you have watched your peers talk about their investment portfolios and felt a quiet sense of anxiety. Here is what I want you to take away from this video. The most expensive financial mistake is not starting late. The most expensive financial mistake is not starting at all. You have, depending on your age, somewhere between 15 and 25 years of earning potential ahead of you. You have catch-up contribution limits designed specifically for your situation. You have index funds with historical long-term returns that have rewarded patient investors across every generation and every economic cycle. The economy right now is complex. Inflation has come down from its peaks, but it has reshaped the cost of living in ways that will take years to fully normalize. Interest rates remain elevated by the standards of the past decade. The stock market continues to price in uncertainty about geopolitics, technology disruption, and fiscal policy. But here is what history has shown: through every war, every recession, every financial crisis, every technological disruption, and every geopolitical shock of the last century, the American economy has always recovered. And the investors who stayed disciplined during the difficult periods were always the ones who captured the returns that followed. You are not too late. You just need to start, and you need to start today. The world is interconnected in ways that previous generations could not have imagined. A decision made in a central bank in Frankfurt can move mortgage rates in Phoenix. A conflict on the other side of the globe can change what you pay at the gas pump next month. A shift in trade policy can reshape the value of your portfolio in days. Understanding these connections, between global events and your personal finances, is no longer optional. It is one of the most important forms of financial literacy available to an American investor in the 21st century. And yet, knowing something intellectually and acting on it are two very different things. You can understand compound interest perfectly. You can know every tax-advantaged account by heart. You can recite the historical returns of the S&P 500 in your sleep. And still, make every financial mistake in the book. Because the biggest obstacle between most Americans and financial security is not information. It is behavior. It is the version of you that checks your portfolio every single morning when the market opens. The version that reads one alarming headline about a potential recession and quietly moves everything to cash. The version that tells yourself you will start investing seriously next year, after the car is paid off, after the kids are in college, after things calm down a little. Things never calm down. That is one of the few certainties in both economics and human life. So in this next part of our conversation, we are going to go deeper. We are going to talk about the advanced strategies that most financial content glosses over. And we are going to talk honestly about the psychological forces that quietly sabotage even the most well-intentioned investors, and how to beat them. Because building wealth after 40 is not just a math problem. It is a psychology problem. And the investors who solve both are the ones who actually make it. Let us start with one of the most underappreciated risks in all of retirement planning. It is called sequence of returns risk. And if you have never heard of it, What I am about to tell you may be the most important thing in this entire video. Here is the concept. Imagine two investors. Both retire at 65. Both have exactly $500,000 saved. Both earn an average annual return of 7% over a 20-year retirement. On paper, they are identical. But Investor A retires in a year when the market immediately drops 30%. Investor B retires in a year when the market immediately gains 20%. 20 years later, Investor A has run out of money. Investor B has more than $1.2 million remaining. Same average return. Same starting balance. Completely different outcomes. The only difference was the order in which those returns arrived. This is sequence of returns risk. And it is the reason that the decade immediately before and immediately after your retirement date is the most financially dangerous period of your investing life. When you are 35 and the market drops 40%, you are devastated emotionally, but financially, you recover. You have decades of future contributions ahead of you. The lower prices actually mean you are buying more shares at a discount. When you are 67 and the market drops 40% while you are simultaneously withdrawing $50,000 per year to live on, the math works very differently. You are selling shares at depressed prices to fund your living expenses. Those sold shares never recover for you, because they are gone. And the remaining portfolio has to work much harder just to get back to where you started. So what do you do about it? The most widely used strategy is called the bucket approach. Instead of thinking of your retirement savings as one single pool of money, you divide it into 3 buckets based on when you will need the money. Bucket 1 holds 1 to 2 years of living expenses in cash or very short-term, stable instruments. This is your immediate spending money. It does not grow much, but it also does not fluctuate with the stock market. If the market crashes in year 1 of your retirement, you live off bucket 1. You do not touch your investments. Bucket 2 holds 3 to 7 years of living expenses in moderately conservative investments, a mix of short and intermediate bonds, dividend-paying stocks, and other income-generating assets. This bucket is designed to be refilled from bucket 3 during good market years, and to refill bucket 1 during periods when you prefer not to sell equities. Bucket 3 holds the rest, your long-term growth assets, primarily stock index funds. This bucket has a time horizon of 10 or more years. It can absorb short-term volatility because you have given it the time it needs. The psychological benefit of this approach is just as important as the mathematical one. When the market falls 35% and every news channel is declaring financial catastrophe, you are not panicking. You are calmly living off bucket 1. You know your short-term needs are covered. And you know that bucket 3, despite the temporary decline, will recover, because it always has. The bucket strategy does not eliminate risk. Nothing eliminates risk. But it manages the timing of when you are exposed to that risk, which, as we have just seen, makes an enormous difference in outcomes. And that difference in outcomes is exactly what this entire conversation has been about. We started this video with a question that millions of Americans ask themselves in quiet moments, usually late at night, when the reality of the future comes into focus. Is it too late? And we spent the last 30 minutes answering that question with data, with history, and with strategies available to any American willing to use them. But I want to be honest with you about something before we close. Having the right strategies is necessary. It is not sufficient. Because the single greatest threat to every financial plan we discuss today is not the stock market. It is not inflation. It is not interest rates or geopolitics or any external force at all. It is the investor. The version of you that checks the portfolio every morning and feels the urge to react. The version that reads one alarming headline and quietly moves everything to cash. The version that tells itself, I will start contributing more next year, after things settle down. Things never settle down. And the investors who build real financial security are not the ones who had perfect timing. They are the ones who understood their own psychology well enough to stop it from working against them. That is what we tackle in Part 2. Advanced Tax Strategies. The behavioral traps that silently sabotage even well-intentioned investors, and how to beat them. Income diversification. And the global forces shaping your portfolio right now. Part 2 is coming very soon. Subscribe and hit the notification bell so you do not miss it the moment it goes live. The best time to start was 20 years ago. The second best time is today. I will see you in Part 2.